All right, thank you, everyone. It is 3:25 and time for our ninth panel of the day. We are getting close to the end, but we've got a couple good ones still to go. This is our financial firm focus panel. Well, they will talk about the SEC's enforcement priorities for asset managers, broker-dealers, private funds, and hedge funds. Our moderator for this panel is Josh Newville, who is based in New York, where he is a partner in the litigation department and a member of Proskauer's Securities litigation group and the asset management litigation team. Before joining Proskauer, Josh was senior counsel in the U.S. Securities and Exchange Commission's Division of Enforcement, where he investigated and prosecuted violations of the federal securities laws. He was also part of the AMU within the division. We also have on the panel LeeGreenwood, who is an assistant regional director in the SEC's Division of Enforcement and a member of the Asset Management Unit. And Lee is based right here in the New York Regional Office. Next to Lee is Daniel Michael. Daniel is a partner at Skadden in New York, where he is co-head of the firm's Web3 and Digital Assets Group prior to joining Skadden. Daniel served as the chief of the SEC Enforcement Division's Complex Financial Instruments Unit, where he oversaw a nationwide team of attorneys and market specialists in investigations and enforcement actions involving complex financial products and market practices. Next to Daniel is Julie Riewe. Julie is a partner in the Washington, D.C. office of Debevoise and Plimpton, where she is a litigation partner and a member of the firm's White Collar and Regulatory Defense Group, and a member of the firm's management committee. Prior to joining the firm, Julie was co-chief of the Asset Management Unit in the Division of Enforcement. She also served as deputy chief and assistant director of the AMU and branch chief in the Enforcement Division in Washington, D.C. And last but not least is Howard Scheck, who is a partner with StoneTurn in Washington, D.C. He is an accountant and attorney with over 3 decades of experience leading teams investigating a wide range of financial reporting issues. Prior to StoneTurn, Howard served in the SEC's Division of Enforcement as both an attorney and as the chief accountant in the Division of Enforcement. Thank you all very much for being with us. Josh, over to you.
Thank you, and welcome everyone to our panel of distinguished experts. It's not quite a master class, but it's close. So we're in a time of transition for the financial services industry and firms that are in our space. The Commission has been very focused on certain issues for registered entities, and there were a bunch of cases that the Commission filed in the last couple of months before the turnover. So we're gonna talk about those cases. And we're going to talk about what the priorities are. We're going to read the tea leaves. We're going to predict what the next cases are that are going to come against asset managers. Luckily, we have LeeGreenwood here, who's not going to talk about that, but some of our other panelists will. But I do want to ask you about some of the SEC's more recent cases. Would you like to do your disclaimer first?
Yeah, absolutely. So my statements today are made in my official capacity as an assistant regional director in the asset management unit. Do not necessarily reflect the views of the Commission, the commissioners, and other members of the staff. Thank you.
Well done. So let's talk a little bit about compliance focus cases involving asset managers, and MNPI is always, kind of the key issue that clients that I work with think about. And the SEC has been a little more focused on the credit markets and credit instruments, CLOs, claims in bankruptcy, those types of cases. AMU has had some involvement in recent cases. Tell me a little bit about how you think about those.
Sure. So it's a good point. I mean, I think the central statute that we look at in that context is Section 204 Cap A of the Advisors Act, which requires registered investment advisors to establish, maintain, and enforce written policies and procedures reasonably designed, taking into account the nature of their business, to prevent the misuse of MNPI. And so and the Commission has brought a number of 204A cases over the last really 6 months I think two to kind of focus on, to your question, Josh, are the SoundPoint and the Marathon cases that came out in August and September of last year. Both cases involve participation in ad hoc creditors committees. So groups of large creditors, similar interests, getting together to explore restructuring opportunities with an issuer prior to a bankruptcy. And so I think we talk about sort of the ad hoc nature of some of these creditors committees, but that ad hoc nature can heighten risks. And so in the SoundPoint case in particular, SoundPoint was a CLO manager that traded CLOs, both that it managed and CLOs of third parties. SoundPoint also had a credit business, which often resulted in it participating in ad hoc lenders committees. And through that business, SoundPoint comes into possession of MNPI. So SoundPoint was aware that it could receive this kind of MNPI through its credit business. This is all according to the SEC's order. But the core policy deficiency in that case was that SoundPoint didn't have written policies and procedures that were reasonably designed to focus on that core concern about the misuse of loan MNPI as it relates to its CLO trading. The order, I think, goes into detail of one of the things that can happen when you're not looking at and not assessing the potential materiality of MNPI on one business line to another business line. And so, I think the order spells out a situation where SoundPoint has MNPI, it sells first loss equity tranches of a CLO, negative news comes out, loan prices go down, CLO tranches go down, materially impact the value. So the bottom line in that case was SoundPoint didn't consider the potential impact of the MNPI before the CLO trades. I think Marathon case, very similar. Marathon participated in investing in distressed corporate bonds, other similar debt as part of its core strategies. It interfaced with investors, financial advisors, and consultants as part of the ad hoc creditor committee process, and came into MNPI. And the order in the Marathon case notes that while Marathon did have MNPI policies generally, it found that those policies were not reasonably designed because they failed to address the specific risks that were present for Marathon. So I think like a couple compliance-related takeaways here, three. First, fairly obvious, but really important for advisors to think about and take into consideration the ways in which they may come into possession of MNPI. That means different things for different advisors with different and sometimes overlapping business lines. So the question is, how do you mitigate that risk in the context of your specific business lines? Second, arm your compliance groups. Really think about what tools can a compliance group have that will allow it to succeed, whether it's escalation protocols or specific tools to evaluate the impact of one kind of MNPI on other products. For instance, the SoundPoint order talks about a CLO pre-trade approval process that was put in place by that firm that didn't have information barriers. So just an important sort of thing to think about, how can compliance succeed? Third, cooperation, remediation, extremely important to the SEC. That's evident in SEC orders. It's in there for a reason, and it's in there for the SoundPoint and the Marathon cases as well.
Yeah, and when I'm thinking about the Marathon case, it's the compliance lessons are tough because the firm apparently said, we don't want MNPI. We want to stay on the public side. Don't give us MNPI. We're trying to not restrict. And they told their consultants that. And so it's hard to figure out what it was that they did wrong and how they could have done that better. Yeah. Is there a takeaway you can give us on that point?
Yeah, for Marathon, I think it's how do you reduce that risk of potentially receiving, at times, inadvertent MNPI to your policies and procedures. I think that was sort of the core issue in the Marathon case.
So I want to turn to everyone's favorite topic in the financial services industry, text messaging and off-channel communications. We had the most recent round of settlements in January. Julie, where do all those cases go from here?
I think hopefully nowhere. We saw the going out of business sale a couple weeks ago, I think, against the private fund advisors and broker-dealers with lower penalties that we had seen, just thinking about it holistically, over the past couple of years. So, hopefully that's more or less the end of these, at least as standalone enforcement actions. I guess we'll see. I know there's still some investigations kicking around where the consequences of the new administration have maybe not completely made their way down to the line staff level, but hopefully those will end up getting closed. And then, I think it'll be regular way exam deficiencies for registrants, at least, when the exam staff sees firms that they think don't have the appropriate controls or policies and procedures. So I think we'll continue to see that on the exam side, but hopefully that's really the end of it. And I think, Hester and Mark kind of signaled that in their dissents in Catalyst, basically saying, I think they said, it does not appear the firms have an achievable path to compliance, which I think is where folks are. There's always going to be foot faults, stray texts, and the like. And so I think, this new commission, I expect, is not going to be very interested in these kinds of cases as standalone. That said, 2028 comes quickly, and the exam staff at least has for registrants has a look back period. It could be 2 years or more, and so at least we've been counseling folks to get your house in order, even if now is the good time to get your house in order and be in a good position for if and when there's more focus on this down the road.
Dan Michael, related question. Do you think the entire industry is now in compliance?
100%.
100%.
No, but it couldn't be more true. It's an impossible standard. I mean, there's instances where folks had almost no texts, and then they're like, okay, well, we would like to pick additional custodians. It's like, at a certain point, it is impossible. So it's just incumbent on everybody. And I agree, I think the pressure in terms of sweeps is off, but it's obviously still an important issue. You don't want your workforce conducting business on channels that you can't see. So still just keeping on top of it, being mindful, I think is important. I mean, one of the silver linings is it did get a lot of people to think about it. Technology improved over the last couple of years in terms of texting capabilities that can feed through global relay and the like. So, just continuing to think about it and not totally writing it off, I think is in everyone's interest, because I think the enforcement staff have learned kind of their lesson, and a lot of times when they send subpoenas out, they're also asking for personal data on the side, just in case, just to cover their bases. And if things start popping there, that's kind of eyebrow raising to them. I could see even in the new administration at least contemplating whether a charge is appropriate here, because that would be a very organic way to go about it. So pressure is reduced, but not off.
So, Lee, I want to continue to engage with you on some of the cases that that the unit has brought. The SEC recently settled a case with a large quant fund manager. This is a Two Sigma case where there was a modeler who went around the controls and made unauthorized changes to the modeling. And the SEC brought that case against the firm as a violation of fiduciary duties. I'd like to hear your thoughts on that case and how that kind of case turns from a problem with one individual to you violated your fiduciary obligations to the fund.
Yep, it's a good question, and you're getting at the duty of care charge. That's the Section 2062 charge under the Advisors Act. As you noted, it's about a quant fund. We'll refer to it's a couple different advisors. We'll refer to it as Two Sigma. But the issue was not just that a modeler made unauthorized changes. The order finds that there were specific vulnerabilities to a database that housed key parameters to models that were being used in live trading. And those parameters could be changed without review or approval. And that was an issue that folks at the firm, according to the order, recognized, and they recognized it for a long time. And the order identifies over the course of 3, 4, 4.5 years, employees are discussing this particular vulnerability and ways to fix it. The order describes some of that back and forth. The bottom line, it wasn't fixed until the modeler's changes, which were able to exploit this very known vulnerability, came to light. So the issue is not penalizing the firm for a modeler gone rogue. The issue is, did the firm satisfy its fiduciary duty of care, which I think the order sort of describes as, including acting in a client's best interests. That includes taking steps to minimize known or reasonably foreseeable operational risks that could lead to significant business disruptions. And those are the kinds of risks, when you look at a model-based advisor like Two Sigma, that sort of fall squarely within the duty of care. So the question is sort of how do you apply those duty of care principles to an advisor in this space? Models are the core way in which a firm like this makes investment decisions on behalf of its clients. And because of the failure to correct that known vulnerability for years, that's sort of the basis for the duty of care charge.
I mean, you look at that case, and there's a recognition in the order that they conducted an investigation. They paid money back. They did all that, and they were still faced with a decent settlement. I wonder how the next commission might look at that situation. Maybe different, but let's talk about Reg BI. Important for wealth management shops, broker dealers, and we've seen over the past couple of years kind of a push to democratize investment opportunities, for maybe retail investors, maybe more individual investors, to make private style investments more available to folks. The AMU had a matter this past year involving a large wealth management shop that had some interesting allegations relating to conduit products. I'd love to hear your thoughts on that case.
Yeah, so you're referring to the JP Morgan Securities case at the end of October. So the case involved a product that JP Morgan made available to higher net worth customers, but not the kinds of people who could necessarily invest directly in a large hedge fund. And the conduit would pool customer money and then allow customers to invest through the conduit in one of these larger hedge funds. So sort of democratizing the access to those funds. On occasion, the third-party fund, the hedge fund, would receive post-IPO shares back and distribute those shares to the conduit. Conduit appointed a JP Morgan affiliate to act as an administrator. The administrator appointed another JP Morgan affiliate to distribute the shares, and the resulting cash then went back to these sort of higher net worth retail investors. But according to the order, contrary to the disclosures, and it's a disclosure case, the JP Morgan distribution management team was exercising advisory discretion, complete discretion, over managing those shares, deciding when to sell and how much to sell. And what that meant is during challenging market conditions between 2019 and 2022, the team sold those shares for losses because they held those shares for longer, given developments in the market. Like every product, I think the bottom line is think about what disclosures are being made to investors. The order in this case makes clear that these were brokerage customers who were investors in the conduit, who signed up to participate in a conduit program that allowed for and described the distribution of the shares as promptly as practicable. And they were not advisory clients that were signing up for that kind of exercise of discretion. So it's a mismatch, in this case, as the order finds, between the disclosures to brokerage customers and what ultimately happened on the other side of it.
So Dan, I want to ask you, like the Reg BI cases, I don't know if that's necessarily the similar type of analysis as we saw in that case, but how do you see those cases developing now in your practice?
Sure. So Lee's being very careful, can't speak about what's going to be happening in the future. There's in fact someone with a cattle prod behind this curtain, but I can speak freely. I think it'll definitely be an issue or a focus of the new administration. I mean, Reg BI focuses on protecting retail customers. It's hard, I mean, obviously during Jay Clayton's tenure, that was the most important priority. It's hard to imagine it not being at least a priority this time around. So I definitely think that it's something that firms should be continuing to think about, especially with, as Lee pointed to, with the democratization of products. There's more choice, there's more availability, raises questions of suitability, and that suitability question goes to the heart of the care obligation that Reg BI imposes. The other thing that I just want to mention is I think I've noticed just over the past couple of years kind of an evolution of how the enforcement division thinks about Reg BI. So, there's 4 components. There's a disclosure obligation, a conflicts of interest obligation, compliance obligation on top of the care. And when it first came into effect, there was a lot of focus on the care obligation in terms of suitability, such as the case Lee mentioned, some others. I think the division is now starting to find its way with respect to the others. And so an interesting case from last year, Key Investment Management, I think the Chicago office brought that. And so facts are not particularly startling. There was a finder's fee if you referred to an affiliate. But it really raised a lot of interesting questions that I see enforcement staff kind of focusing on currently, which is if there is, the conflict rests in the individual, not in the entity. And so if someone is doing work on behalf of multiple entities, can the interest of entity A and the interest of entity B kind of conflict when they meet in this person? And so that issue raises itself anytime someone's dual-hatted, and you think about, all the services firms offer. A lot of times people are, triple-hatted. A lot of times they'll offer this, they'll offer other things. And so really having a holistic look at not just what are the conflicts within the broker-dealer, but anybody who's out there on the part of the broker-dealer or on the part of wealth management, what else are they doing? What other business lines are they servicing directly or indirectly? And does that create a conflict? And so I think just that type of focus is something that we'll start to see. And I mean, that's goes to the heart of what, kind of investment advisors, the fiduciary duty, I feel like AMU has had that on their radar for many, many years. But I think we're now starting to turn a corner where we see broker-dealers under similar types of scrutiny. So it's just something to keep in mind for that industry.
Dan, when I'm thinking about Reg BI and the suitability analysis, how much documentation needs to go into that for a particular investment?
So the rule doesn't have any particular requirements in terms of documentation, but it says that you need to be in a position to kind of justify your determination, and so it's really incumbent on you to have documentation that is sufficient, because in effect the burden kind of comes on you. It's in that scenario. So really just understanding the particular client, really understanding the particular product with respect to vetting through new product committees and the like. And then, it's hard to do a really in-depth analysis every single time for every client. So at least parameters that management can hopefully guide their workforce to in terms of who this may be suitable for or why. A good process of flagging exceptions to that, so there could be discussions. But basically the more documentation, the better.
The government always likes to see more paper in the file.
Yeah.
Right.
Always.
Howard, I want to talk to you about valuation. You've had a lot of experience in valuation, matters involving alternative investments. What do we do with ASC 820 when thinking about those? Tell us about how some of those investigations have developed.
Yeah, sure, Josh. And I guess everyone thought they were done with accounting after the financial reporting panel was over, but I'll talk a little bit about ASC 820. Essentially, it's, as folks know, it's the accounting rule that governs how entities measure and report fair value. And the SEC looks, both OC and enforcement look to ASC 20 when they're doing examinations, when they're doing enforcement investigations related to those issues. Entities that are governed by the Investment Company Act have to report their assets at fair value. So the way that the issues have come up, in my experience, and worked on a number of cases over the last couple of years, is what you would typically expect from whistleblowers, from OC referrals. I mean, if they can't resolve it with the OC examination, they might refer something to enforcement. And through data analytics, where DERA or somebody is working with enforcement and DERA together are doing data analytics and coming up with potential targets and investigations there. So ASC 20, as it's important to know, like there's a hierarchy. There's level 1, 2, and 3. Level 1 is the easy stuff where you can go to the newspaper and look at the quote. Level 2 is similarly situated asset. But the real issues usually come up with level 3, where there's no observable inputs, a lot of judgment involved.
We're always in level 3.
Yeah, there's methodologies that have to be used. So typically what the investigations are looking at are, first of all, whether they have policies and procedures in place to do the methodology in the first place, how well they're documented, and then looking at, well, are the valuations materially overstated, and then looking at, the disclosure. So there's no single method that has to be used. It has to be reasonableness of the inputs. And there's been a number of cases in the last couple of years. One issue I think is probably interesting to mention is permanent and permanent write-down issues. There's been some cases where, particularly in this industry, they don't do the management fees based on the fair value. They do it on the invested capital. So there's usually provisions that call for look at whether there's a write-down or a permanent impairment, and if so, then they have to adjust the base that they're calculating the fee on. So there's been a number of cases, a few where that was the issue. And one interesting point on that is you have to look at the investment value, not the portfolio company value, because the portfolio, the fund, private fund might own debt, they might own warrants, they might own preferred stock, and so you have to look at whether those particular investments are impaired and whether there's a write-down necessary for those, not look at the enterprise value itself.
Right, and you see this with venture investments or venture funds, where the concept of a permanent write-down is not necessarily something that's an accounting concept. It may not necessarily be something that's defined in an LPA, and so potentially there's some discretion in how you think about it.
Exactly, because the accounting rules and the way they calculate the permanent write-downs for those are different, but they still have to have policies in place, and they still have to have procedures in place so they know whether they're following consistently.
Yeah. Dan, what kind of valuation issues have you had come up?
So I think similar to Reg BI, I think I've noticed definitely an evolution. I think in the beginning, when I was at the agency a long time ago, the thinking was you really need a cooperator. It's so subjective. These are, such esoteric instruments most usually. I mean, like to really prove it, you need someone to say that, no, we didn't have a good faith belief. And I think as time went on, the division in the agency as a whole got a little more comfortable. So, to where I left around 2021, the agency was charging and even litigating mark-to-model cases challenging the unreasonableness of assumptions. And so that, I think, is a pretty remarkable evolution, and I think that evolution continues today. And I think it's really also at the forefront, the group that's at the forefront, at least in my mind right now, is Division of Examinations. They're in a really good position to kind of see valuations just in the normal course of an exam. And I've noticed over the past couple of years, less and less shy about challenging. And the thing with valuation, it's something that can really come up in any type of market. Bad times, obviously, you want to hide losses. Good times, you may want to, spare some gains for later. Average times, you may just want to be better than your competitors, or maybe you really have a you have a lot of conviction in terms of your thesis that may be coloring your valuation. And so I think in any of those circumstances, really lends itself to the prospect of being questioned by the exam staff. And I think I've seen, just really across types of issues and products, whether it's CLOs, even for equities, was there a discount rate if it was restricted or if liquidity was not fully there? So, really just kind of thinking through those issues, and it's kind of a low, enforcement. There's a lot of high stakes if you bring a case. Obviously, you're going to be trying it. The charge is fraud. It's much lower stakes for exam. I mean, they're wrong, then they just close out the matter. There's kind of no harm, no foul. And so I see them kind of testing things, really trying to get a sense of where valuations are off or where things don't make sense, and they're much more willing to charge them as deficiencies. And I think just given the stakes down the line, I think that really underscores the importance for just making sure that you're putting your best thinking forward at the beginning, because what you don't want is you kind of think through one answer, then it goes to enforcement, and then you just kind of realize there was all these other factors at play that aren't really fully consistent with or incorporated into your exam response. So just a few things.
One thing to keep in mind, Dan, is that we've seen that the OC examiners may not be fully fluent in ASC 820 and all the issues, and whether they've consulted with the Division of Investment Management, OCA, is an issue. So there are opportunities to push back if you're working on the exam side as well.
That's why they're stated as apparent violations,
Right.
not actual violations. I want to move on to the ESG space. The unit has brought some cases involving, don't say greenwashing, they are disclosure cases, managers for overstating their ESG capabilities. Lee, I'd love to hear your thoughts on the Wisdom Tree case.
Yep. Well, you took the words out of my mouth. I mean, we do think of them as disclosure cases, say what you do what you say kind of situations. The question is, what is an advisor saying to fund boards and to investors about its investment process, whether it relates to ESG or something else, and is it doing that? So Wisdom Tree, good example. There's a case from October. Wisdom Tree advised 3 exchange-traded funds that had the ESG moniker in its name. According to the order, Wisdom Tree misstated in those disclosures to the board, as well as to investors, that these funds would not invest in companies that were involved in, quote, in certain controversial products, including fossil fuels and tobacco. And I think the disclosures even went further and said that Wisdom Tree would not invest regardless of revenue. The order found that, in fact, the investment model that Wisdom Tree used did invest in fossil fuels and tobacco companies, and identifies some examples in the order. I think that's ultimately because the order identifies that there were known gaps in the difference between sort of what the data sets were that Wisdom Tree was using and those disclosures. There's nothing wrong with a data set with gaps or limitations. That's how it goes. The question is, are those gaps reflected in disclosures? So for Wisdom Tree in particular, they had a situation where there were disclosures to the fund boards about an exclusion, a broad, absolute exclusion of no fossil fuels or tobacco. But as the order notes, that there was no fossil fuels data set for use from their vendor. So the question was, what's the delta between the disclosure, which used broad language like involved in fossil fuels, involved in tobacco, and what they were actually doing?
I mean, there's some interesting materiality points in those cases as well, but it's a settlement, so.
Yep. The order's fine that they're material, and certainly.
Julie, so there's been a lot of focus, particularly from some of the red states on the use of ESG type components in investing. Do you think maybe in the next year or two we'll see a green hushing case, the anti-ESG case?
Yeah, I think so, or at least there's going to be an effort to find one. So green hushing, I think the theory is that some of the anti-ESG states, because they're putting a lot of pressure on managers to walk back their ESG commitments and their ESG focus, that some of those managers, while they have changed disclosures, they may actually still have baked into their operations and some sort of operational commitment to ESG down in the bowels of the organization. And I think the theory is that either the state AGs or potentially the SEC, enforcement or exam, will look at these managers and say, you're actually looking at ESG or climate type factors as part of your investment process, but when you write your diligence responses, you refer to the factors you're considering as financial factors instead of ESG factors or climate factors. And so I think we're going to see potentially a swing in the other way where the staff, states or federal could look at some of the managers who are downplaying, either knowingly or unknowingly, downplaying what they are doing in terms of ESG. And so I think just the interim effect of that would, at least for the red state anti-ESG lobby would be pretty effective to go in and look deep into a manager's operations and try to see whether there's coding that relates to ESG factors that just inadvertently weren't pulled out of the system as they moved away in their disclosures from focusing on ESG. So yeah, I think it could be very interesting.
Yeah, and it's kind of a whipsaw effect where certain investors, they want to be in that space, and certain pension funds even, they say you're not allowed to be in that space.
Right.
It's illegal under our state's laws.
Right.
So I want to touch briefly, Howard, on some of the interesting allocation issues. So the SEC and DOJ are bringing a contested matter against a portfolio manager at WAMCO involving trade allocations. Tell us your thoughts on that case. How do those types of issues come up?
Yeah, I think it's a very interesting case. I mean, it came up. It looks from the litigated case, the order through. It's cooperation between the asset management unit and DERA and the Southern District, but it looks like they did a lot of data analytics in DERA to come up with the findings. Basically, just to level set, like trade allocation is when a block trade is done, and then they have to allocate it to different customers or accounts, and there's a risk of cherry picking, that they might allocate those trades to either their proprietary accounts, if it's a broker dealer, to employee accounts or favored customers. So in this case, they at WAMCO they found that the CIO. The former CIO, I should say, despite having a policy that required either pre-allocation through compliance or prompt allocation right after in use of their electronic trading system. They had training on this. The CIO was charged, actually sent out an email reminding people to allocate promptly, yet he did hundreds and hundreds of trades for hundreds of millions of dollars where they allocated the day one gains to favored accounts. And I think DERA calculated that the chances of the gains coming out that way were 1 in a trillion. So I think it just shows that you need to have policies and procedures in place. You need to follow them. If there's exceptions to the allocation policy, at least have reasons and document why that exception occurred. And usually it's done pro rata, but if there's some other reason, they should at least be able to go back and explain why. But I think it's litigated, so we'll see. A lot of data to go through the trial. They haven't charged the firm, so we'll see.
We'll see.
The press release does say the investigation
is ongoing,
for whatever that's worth. So.
And I think whether the explanation is those were allocations done for risk management purposes. I don't think that explanation was bought by the government. I want to touch on a couple of issues that have come up over the last few years. I'm calling this kind of the lightning round. Julie, on 21F17, language that impedes whistleblowers. Where do we see those cases going over the next year?
So I think there's going to be a pullback. I'm a little less sanguine about this just because there was support from Hester and Mark on a number of these cases over the past couple of years, and you'd see Hester or Mark dissenting sometimes from the remedy, but pretty rarely from the charge itself. That may have knock-on effects where staff doesn't really want to investigate whistleblower cases if what you're looking at is a penalty at the end of the day. No penalty C&D cases for the old people in the room. And so, I think they'll continue to investigate them. The exam staff, again, is out there when they're inside registrants looking at all of their documents, and, you can always find some document that's in the bowels that hasn't been updated, and so they get cited still as deficiencies. So I think we're probably not done with it, but hopefully it'll just be in the more egregious, what they would view as the more egregious kinds of cases, instead of any language that they can find some sort of agreement that doesn't have the magic words as impeding, which seems kind of crazy.
Yeah, there's a lot of confidentiality agreements out there.
Endless.
Yeah. Dan. Agreements that limit liability, hedge clauses. Are those violations of fiduciary duty?
I think if you look at I believe Playstone, it certainly may be. I think there was some interpretive guidance put out saying that the staff could, it's hard to think of an instance where they would be okay, and yet they exist in virtually every agreement between an advisor and a client. And so the question is how to square that circle, and savings clauses were long seen to do that. And the case that I just mentioned questioned that, or at least questioned the ones that specifically were there. And so just for benefit, the advisor isn't liable. The advisor's only liable for gross negligence and the like, or some egregious circumstance. And then there'll be a clause that says, however, nothing limits your ability to, or nothing curtails a cause of action that is available under the federal securities laws. And so that however clause was the savings clause that was seen to kind of comply with the securities laws, because there's a provision that, or whether, actually I don't remember, case law or provision that says you can't disclaim or contract away any obligation of the fiduciary duty. And that includes causes of actions that may be brought against you as a fiduciary. And so I think what the enforcement staff in that matter, or rather the commission in that matter, we're finding instances where there was daylight. You were kind of hedging or excluding liability for this, but the savings clause only covered that. And so there's a little bit of a delta. And so ways to obviously fix that is just to make sure the savings clauses and hedge clauses are kind of coextensive in terms of their coverage, and also just making very clear that you're not waiving any aspect of the fiduciary duty.
Julie, pay-to-play cases. Are we done with those?
I think we're done with those, unless there's an actual quid pro quo, a link between the donation and the investments, in which case it's criminal matter, really, not an SEC. So I think we're done with those. Hester and Mark have really hated them over the years, and I think they will continue to hate them.
Dan, compliance rule settlements, where it's just a violation of the compliance rule. Are those done?
I think they are going to be limited, but I don't think they're going to be done. Sometimes you have a bad set of facts, and for whatever reason, maybe there's no materiality, maybe there's no this or that. There's a case that there's an instance where investors were harmed, where there really is a benefit to bringing that case, and so I think you'll see that. What I don't think you'll see is the ones that are kind of brought for their own sake, and so I think they'll just definitely be a reining in, but still, I think over the, however many, 20 years or so the rule's been out, definitely some flexibility and creativity on the part of the staff and the commission in terms of what may be covered there, and I think to some extent we'll still see it.
Yeah. It'll be interesting to me to see, if we've got the same conduct, and the commission doesn't want to bring corporate penalties that challenge shareholders. Same conduct. You've got a privately owned fund manager, and you've got one that's part of a large publicly traded entity. Whether that's the same penalty. Any predictions?
That's actually a good question. Let me ask Lee. Just kidding.
No predictions. No predictions today.
I would say if they're brought close in time, they'll be the same. If not, they won't.
Let's have a warm round of applause for our